Today we'll look at two interesting stories. The first one looks at Reliance's recent results, and the next story talks about the fight between TRAI and Truecaller. Welcome back to the Daily Brief show by Zerodha, where we cut through the news to help you understand what's actually happening in the most important stories from business and markets. I'm your host Krishna, and today is Friday 24th July. Now, Reliance had a strong start to FY27. In the first quarter, their revenue grew 24.5% year-on-year to 3.4 lakh crore, and recurring EBITDA rising 10.1% to a record 54,000 crores, and recurring profit increasing 6.1% to about 23,000 crore. But the profit figure needs some context. On paper, Reliance's profit fell nearly 25% from the same quarter last year. Now that is because Q1 FY26 included a one-time gain of 8,924 crores from the sale of its stake in Asian Paints. Once this exceptional gain is removed, giving us a fairer comparison of the underlying businesses, Reliance's profit actually grew by 6.1%. So the reported profit was lower, but largely because it was being compared with an unusually high base. Now the individual businesses themselves have performed better. Now, as always, the story doesn't change significantly between two consecutive quarters. But the nuances of individual businesses have certainly become more interesting, especially as the external environment has changed. Now let's start with Reliance's core business, which is oil to chemical, where it converts oil to oil products like naphtha, ethane and other products that feed into plastics and polymers. O2C revenue grew by 30.4% compared to the last year, while EBITDA rose 17.2% to about 17,000 crores. That is the segment's highest quarterly EBITDA in 4 years, and management themselves described it as an extraordinary quarter. But in their own words, it was hard fought as it was impressive. After all, last quarter, the EBITDA for this business fell 3.7% on a year-on-year basis. Now getting crude oil to the refinery itself had become extremely expensive because of the closure of the Strait of Hormuz. Reliance had to pay heavy crude premiums per barrel, freight rates for cargo ships increased nearly tenfold, while insurance costs also multiplied. The company had no choice but to work around the clock to source crude from alternative regions. Now on top of this, shipping blockades disrupted India's imports of LPG, the cooking gas used by millions of households. Now, to prevent a domestic shortage, the government asked Indian refineries to maximize LPG production. Reliance responded by increasing its LPG production fourfold, which also took away their resources from their petrochemicals business. Now, Reliance also faced a disruption to its ethane supply. With the Suez Canal route unavailable, the company's specialized ships carrying cheap ethane from the US had to take a much longer route around Africa. Now, what went wrong? See, one big advantage came from Reliance's ability to switch between ethane and naphtha. To make plastics and other petrochemicals, companies need to feed their chemical plants with raw materials such as naphtha or ethane, a gas that Reliance imports from the US and is a cheaper substitute of naphtha. Now during the quarter, crude oil prices rose sharply while US ethane prices actually declined. Now Reliance is among the few companies globally with the specialized infrastructure needed to import ethane and use it in its plants. Now this allowed the company to replace some of the expensive oil-based feedstock with cheaper ethane, saving significantly on raw material cost. Reliance has also added 3 new very large ethane carriers to its fleet. The second advantage came from a change in the geography. Reliance rerouted its export away from Europe and towards fuel-starved higher-paying markets in Asia, including Singapore and Australia, which actually earned them better margins per barrel. At the same time, reduced its dependence on Middle Eastern crudes by sourcing more discounted crude from Latin America, Canada, Africa and Russia. Now Reliance's distribution numbers don't look real, with its physical stores spread across more than 20,000 physical stores in over 19,000 pin codes across India. And it isn't just limited to physical stores. Its digital platforms like JioMart and Ajio allow customers to order doorstep service for everything from a packet of milk to a pair of jeans. However, while its gross revenue grew by 7.4% on a YOY basis to over 90,000 crores, its net profit actually declined 14% on a year-on-year basis. Now, there may not be massive cause for alarm in this profit decline though. It appears to be part of a deliberate investment phase. For one, Reliance is spending heavily to build dark stores for its quick commerce business and wants to get to the scale before monetizing it. Interestingly, though, that's a subtle shift from their old strategy of relying heavily on their physical stores as delivery hubs. Now, this obviously requires upfront investment, but it also increases depreciation expenses, putting pressure on short term profits. Its grocery business is already expanding rapidly with average daily online orders growing by 116%. Now, when it comes to Reliance's physical business, things look healthy. Its electronics business recorded an impressive 16% like for like growth. Now, like for like growth measures the sales growth only at stores that were already operating last year while excluding newly opened stores. What's more is that this came at a time when the world has been facing high prices and shortage of memory chips. Reliance's scale and strong relationships with global manufacturers helped it secure inventory earlier than its peers. Meanwhile, Reliance also relaunched the global fast fashion platform Shein in India through its retail ecosystem. The app has already crossed 30 million downloads. Meanwhile, Ajio Rush, which promises to deliver fashion products within 4 hours, recorded a 136% quarter on quarter increase in orders. There is one catch in the overall growth numbers though. Last year, Reliance's consumer brands business, which includes Campa, was counted under retail but has since demerged. Once this is adjusted for a fair comparison, Reliance Retail's underlying revenue grew 11.6% rather than the reported 7.4%. Now, Jio has recently filed their IPO papers and we even broke it down. It is only natural that India's largest telecom operator has its own ambitions separate from the parent company and requires its own independence. During the quarter, Jio Platforms reported revenue of about 45,000 crore with its PAT increasing by about 9% to around 7,700 crores. But of course, the most important indicator in the telecom business is average revenue per user. Jio's average revenue per user or ARPU increased by 3% on a year-on-year basis to about 215 rupees. Notably, in the past 12 months, Jio did not introduce a tariff hike. Customers actually spent more by upgrading to higher tier 5G plans, consuming more data, and using more services within Jio's digital ecosystem. One growth engine Jio is relying on is home broadband through Jio Air Fiber. Traditionally, providing high-speed home internet requires companies to dig up roads and lay fiber optic cables directly to individual homes. Fixed wireless access or FWA avoids much of this work by transmitting internet from a nearby 5G tower to a receiver installed at the customer's home. Jio Air Fiber has now reached around 14 million homes and accounted for 78% of India's new fixed wireless home connection. Now, Jio's main competitor, Airtel, has had a higher ARPU of about 260 rupees on account of its subscriber base leaning heavily towards premium. Airtel has recently tried to push for priority 5G access to persuade customers to upgrade to costlier postpaid plans. This, as we have covered recently, led to a tussle with TRAI. We also recommend taking a look at the Ken's recent story on Airtel survival strategies. Now, how is Reliance's oil and gas mining business faring? The business line primarily revolves around KGD6, a deep water oil and gas block located in the Krishna-Godavari basin of India's eastern coast. Reliance operates the block with BP extracting natural gas from reservoirs located deep beneath the seabed. During the quarter, the oil and gas segment reported revenue of about 6,200 crores, which is up 3.2% from last year. EBITDA stood at around 5,000 crores, translating into an exceptionally high operating margin of 79%. However, KGD6 is now experiencing the natural pressure decline that occurs as an underground reservoir matures. KGD6 produced 7.4% less gas during the quarter than it did a year ago. These lower volumes place some pressure on the segment's earnings. Now, during the quarter, the government lowered the price ceiling for deep water gas to about $8.9 per MMBTU. Reliance consequently realized an average price of $8.89 per MMBTU, down from $9.97 in the same quarter last year. Reliance partly offset this pressure through condensate, a light form of crude oil produced alongside natural gas. Unlike deep water gas, condensate was not subject to the same price ceiling. As global oil prices surged during the West Asian shipping crisis, Reliance realized an average price of $107.4 per barrel for condensate, 53.6% higher than last year. The company also benefited from its coal-bed methane operations on land. This is natural gas extracted from coal seams and its price is not restricted by the deep water gas ceiling. Reliance was therefore able to capture more of the increase in market prices, selling this gas at an average of $12 per MMBTU. Now, New Energy is hardly the biggest of Reliance's divisions, but they keep calling it one of the most important parts of Reliance's future. And as we have mentioned in our coverage of the Q3 results, Reliance has been making a strong push to move to higher value add products in solar. Now, within solar, the company is placing a major bet on heterojunction technology or HJT. Reliance became the first Indian manufacturer to have HJT cells included in the ALMM list 2, which is the government mandated list of Indian solar suppliers that has come into effect since last month. Now, this is one of Reliance's biggest bets to move up the solar value chain and reduce dependence on Chinese upstream imports. Now, most solar panels today use cell technology such as PERC or TOPCon. PERC, the older technology, reflects unused sunlight back into the cell to improve output but is now nearing its efficiency limits. TOPCon adds a thin oxide layer that reduces energy loss and has become the industry's mainstream upgrade because existing PERC factories can be converted to manufacture it relatively easily. HJT is a newer design that combines different layers of crystalline and amorphous silicon to capture sunlight more effectively. The biggest advantage of HJT is efficiency, which measures how much of the sunlight falling on a panel is converted into usable electricity. While conventional commercial panels generally operate at around 20 to 23% efficiency, Reliance says its HJT cells have achieved efficiency of up to 25.6%. This allows them to produce more electricity from the same amount of land. Now, HJT panels are also better suited to hot climates. Solar panels become less efficient as their temperature rises, which is a major concern in a country like India. HJT cells have a better temperature coefficient, meaning their electricity output falls less sharply when they heat up under intense sunlight. HJT is more expensive and complex to manufacture than TOPCon, and existing PERC factories cannot be converted as easily. It has also historically consumed more silver and indium, both of which are expensive materials exposed to global supply risk. Manufacturers, including Reliance, are working to replace silver with copper, but this still needs to be proven at scale. Now, despite facing several operational challenges, Reliance delivered a very strong quarter. Now, what do we look out for in the next quarter? For one, can O2C sustain its margin as global energy markets change? Then, can Reliance's dark stores help take away share in the quick commerce industry from the incumbents? For Jio, watch its ARPU, air fiber additions, and progress toward the IPO. In retail, look for signs that its investments in quick commerce are beginning to improve profitability. And in new energy, the focus will be on the scale up of HJT manufacturing and whether it begins generating meaningful commercial revenue. Now, coming to the second story. Most of us decide whether to answer an unknown call based on what appears on our phone screen. If it says spam or the screen turns red, we usually don't pick up. Those very spam labels are now at the center of a regulatory tussle over two specific number series in India. On July 10, TRAI said that calls from numbers starting with 140 and 1600 must not be tagged, blocked or filtered whether by a caller ID app or a telecom operator's own network level filtering. The regulator had spent years making these numbers trustworthy by design, and spam labels would defeat that purpose. Truecaller pushed back within days, saying its own users were flagging calls from these series as spam anyway, and that hiding those warnings wasn't protecting anyone. Now, this may sound like a small fight over two obscure number prefixes, but the story goes back almost 2 decades. See, in the 2000s, as phones reached more and more people, telemarketing took off. TRAI had built a do not disturb registry to block spam calls, curb unwanted promotional messages, and protect consumer privacy. But it barely worked. Nothing stopped telemarketers from simply calling from ordinary phone numbers instead of registered ones. TRAI's fix to this was giving commercial callers their own dedicated number series, a phone number that anyone could recognize on site as coming from a commercial entity and not a stranger. Now, getting one of these numbers isn't as simple as buying a SIM card. A business first has to register itself as a principal entity with a telecom operator, declaring who it is and how it plans to use the number. That registration is recorded on DLT or distributed ledger technology. Think of it as a shared Google Sheet that every telecom operator can access, instead of each maintaining its own separate records. Everyone sees the same information, making it a single source of truth. Once registered, businesses who want to make promotional calls can be assigned numbers from the 140 series. The 1600 series is meant for service and transactional calls only from entities regulated by bodies such as RBI, SEBI, IRDAI, and PFRDA, as well as government to citizen calls. Now customers can use their DND preferences to block selected categories of 140 promotional calls, but 1600 calls are intended to remain reachable because they may contain important account or transaction related information. TRAI also runs the DND app where consumers can report unsolicited commercial calls. Separately, the Department of Telecommunication runs a portal for reporting suspected fraud. Complaints through these platforms have led to lakhs of phone numbers being disconnected. So TRAI does a lot of heavy lifting to verify who's calling. Apps like Truecaller don't. They don't rely on registrations or telecom operators to identify callers. Instead, they rely on crowd behavior, like how many people report a number as spam or block it. Over time, their algorithms pick up these patterns from millions of phones. Now that's where the two systems begin to clash. Now take an example of a bank's recovery team calling about an overdue payment. Annoyed customers may report the number as spam even though the call is perfectly legitimate. The same goes for a loan EMI reminder. People might label it as spam on a third-party app even if it's a genuine 1600 number being used for legitimate transaction-related call. Now TRAI created the 140 and 1600 series so these numbers would be trusted by design. Now if an app can still slap a spam label on a verified 1600 number, that trust breaks down at the very moment it's supposed to matter. That's why on July 10, TRAI ordered that these numbers must not be tagged as spam. Now the problem is that TRAI can't order Truecaller along the way it can order a telecom operator. Telecom companies like Airtel and Jio operate under licenses issued by the government and must follow TRAI's rule or risk losing those licenses. Now Truecaller doesn't operate under such a license. Instead, it falls under the Ministry of Electronics and Information Technology, which oversees internet companies and apps in India. So to make apps like Truecaller comply, TRAI has asked the committee to designate them as authorized agencies under India's IT Act. Now that would give TRAI the legal authority to act directly against apps like Truecaller, Haya and Who's Call, something it currently cannot do. Beyond this, TRAI also has proposed changes to its own telecom rules that would impose two more requirements on caller ID apps. The first is relatively straightforward. Today, if users report a number as spam on an app like Truecaller, that information mostly stays within the app's own system. TRAI wants those complaints to be shared with its official Do Not Disturb platform as well, so telecom operators and regulators can use the same data while taking action against spam. The second proposal is more significant. Under India's IT laws, apps like Truecaller are generally not legally responsible for information posted or generated by their users as long as they follow certain rules. Now this protection is known as safe harbor. TRAI's proposal says that if a caller ID app repeatedly ignores its directions, it could ask MITI to start the process that may strip the app of this protection. That wouldn't automatically make the app liable, nor can TRAI revoke safe harbor on its own. But losing that protection would expose the app to a much greater legal risk for the content and label it displays. Now this hasn't gone down well with the industry either. The Internet and Mobile Association of India, which represents these apps, has objected on 3 counts. First, it argues that TRAI simply has no legal authority over internet apps like Truecaller, so trying to regulate them amounts to regulatory overreach. Second, it says forcing apps to share their spam data would mean handing over information they have spent years collecting and refining. Now that data is a key part of how these apps work and a valuable commercial asset. Third, it argues that whether an app should lose its legal protection is a question for India's IT laws, not telecom laws. In other words, TRAI shouldn't be able to use telecom regulations to influence protections that exist under an entirely different legal framework. Truecaller's own argument is that its users block more than 5 lakh calls from these 2 series every day, and suppressing that signal is the real consumer harm. CEO Rishit Junjunwala also argued that forcing an app to hide user-generated warnings is MITI's job, not TRAI's. The company also says by its own account, over 5.1 crore calls from these ranges go unanswered daily. It's a proof that people already distrust these lines regardless of tagging. Now, Truecaller isn't the only player here. Airtel has taken a different approach with a feature called Business Name Display. Instead of waiting for users to report bad numbers, it verifies legitimate businesses beforehand and shows the company's name on your screen before you decide whether to answer. Now, Google's phone app and Haya, whose spam database also powers caller ID on many Samsung phones, also rely on user reports to identify spam, although their data sources and algorithms differ from Truecaller's. TRAI's order protecting 140 and 1600 numbers applies to them just as much. Now, there's also an entirely different route that bypasses TRAI's numbering system. Truecaller sells a paid product called Verified Business Caller ID. Businesses that subscribe get a green verified badge, their name, their logo, and even the reason for the call displayed before you pick up. In effect, businesses are paying Truecaller to establish trust directly with its users, regardless of whether they are using a 140 or a 1600 number. Now you can see why that might bother TRAI. The regulator spent years building a system where trust comes from a number verified by telecom operators. But if people trust Truecaller's badge more than a TRAI-assigned number, that shifts away the center of the trust away from the regulator and towards a private app. Now, in that sense, Truecaller's verification system competes with one the TRAI has spent years trying to build. Now, this isn't an abstract regulatory fight. A 1600 series call could be your broker warning of a margin shortfall or your bank asking you to update your KYC before your account is frozen. Now, these are exactly time-sensitive calls the series was created for. Both sides have a point. TRAI spent years building a system where these numbers could be trusted by design, so crowdsourced spam label undermines that effort. But apps like Truecaller aren't creating the distrust either. They're reflecting what users experience. The deeper issue may lie elsewhere. In practice, the line between a genuine service call and a promotional one has become increasingly blurry. Many calls may be perfectly legitimate under TRAI's framework, but they don't feel necessarily the way that the person receiving them. Users aren't judging whether a call complies with telecom regulations. They're judging whether they wanted it in the first place or not. That's why they mark these numbers as spam. Going after caller ID app addresses whether that frustration shows up, not necessarily what causes it. Now, coming to the tidbits. Amazon has laid off employees within its Artificial General Intelligence or AGI division as a part of the ongoing corporate restructuring. The tech giant stated that these targeted cuts will help redirect resources toward the most important AI projects. The government has officially approved Qdenga, India's first ever dengue vaccine for individuals aged 4 to 60. The two-dose vaccine protects against all 4 virus strains and can be given without the need for prior dengue testing. HCL Tech is investing 730 crores to build its first company-owned AI-optimized data center in Bhubaneswar. This major digital infrastructure project is expected to increase 6,000 high-skilled tech jobs in the state. The Indian government has dedicated a massive 40,000 crore fund to safely and scientifically close exhausted coal mines. The reclaimed land will be repurposed for renewable energy, ecotourism, and agriculture to support local communities. German automaker Volkswagen is in advanced talks to sell a majority stake in its Indian business to JSW Group. This potential deal aims to inject fresh capital to boost the company's local manufacturing and electric vehicle ambitions. That's it for this episode. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.